Hello and welcome to another accounting video. We're going to talk about notes receivable in this video, the recognition and interest accrual at the end of the year. And the second video will talk about the disposal of notes. So let's start with first bringing the notes into our books. So we're looking at an example over here where we have a company that has, in the last 2 months of the year, 3 transactions that has resulted in notes receivable being recognized in their books. And at the end of the year, they're going to do interest accrual. So on November 1st, they loaned an outside party $20,000 cash, and they've accepted a 1-year 10% note. So this is a case in which they have given a business partner a loan. In exchange, they have accepted a notes receivable. That's a promise that they will return the money to us. I'm giving cash right now, and the terms of the note are 1 year, 10%. It's really important to keep a note of the details over here. The details being the date of the transaction, who the party is, and what the terms of the notes are. Now let's look at the second transaction, December 11th. We sold goods to a customer receiving $9,000 90-day 8% note. Now, this is a little different from what we have seen before. In the past, when we had a sale transaction on account, it was accounts receivable debit, sales credit. So sales will be credited. However, instead of debiting accounts receivable, in this case, I'm debiting notes receivable. This could be a high-risk customer from whom I expect there to be a problem. So I want something in writing from them. I'm charging them interest, or it could simply be the nature of the business I'm in. In some cases, this is common within the industry, such as luxury items that are sold. It could be a yacht, sports cars, etc. These kind of terms are very common in that industry, but not typically for what we are used to seeing. This dollar amount over here for this transaction is $9,000. The third transaction is on December 16th. Here we received a $6,000 6-month 9% note in exchange for an outstanding accounts receivable. What this basically means is I had sold goods or services on credit to a customer. They owed me money. That's a $6,000. And when the due date came, they were not able to make the payment. We have agreed to give them an additional 6 months to make the payment. But now we are telling them we want to charge 9% interest. So we are replacing the accounts receivable with the notes receivable in our books. The terms are 6-month, 9%. So we have 3 different notes issued on 3 different dates. They all carry different terms. So now when we come to the end of the year, December 31st, we need to accrue interest on all 3 notes. The accounts you debit and credit, those are fairly straightforward. It's interest receivable debit, which will be classified as other receivables, and interest revenue credit. That part is easy. The part that we need to pay close attention to is the calculation of interest. So let's do it in 2 steps. First, let's calculate the interest for the full year, because the interest rate is always per annum. The 10%, 8%, 9%, they are per annum. But the period of the note is not for the full year. So let's start out with our first step in the calculation. We have a $20,000 note, 10% per annum would yield us $2,000 in interest. The second note is $9,000, 8% would give us $720 in interest. The third is $6,000, 9% would give us $540. Now, I already mentioned that these notes were not outstanding for the entire year, which means I can't accrue interest for the entire year as yet. November 1st to December 31st is 2 months. So the calculation I need to do, the adjustment that I need to do in this calculation over here is multiplied by 2/12 to arrive at $333.33 as the interest on this note. They've told us to round it off to the nearest dollar. I'll do that in the end. The second note, the terms are 90 days. Anytime they give you in days, we assume there are, in the calculation, we're going to use 360 days for the year, not 365, not 366, 360 days, okay? So how many days was the note outstanding? December 11th, so start counting from the 12th. December 12th through December 31st is 20 days. So the adjustment I need to make is multiplied by 20 over 360. And that's going to give me $40. Now, the last one is a little tricky. We have December 16th. It's a 6-month note. Okay, 6 month. If it was December 1st, the adjustment would have been 1 over 12. But it's not quite 1 over 12 over here. Okay, so the adjustment over here is 1 over 12 if it was a full month, but it's only half of a month, so multiply by half, and that's going to give you interest of $22.50. Okay. Now, finally, what we're looking at over here is when I add up all the interest, I have $395.83. We're going to round it to the nearest dollar. So the amount I'm going to bring into my journal entry is $396. Once again, to quickly recap and see what we're dealing with over here. Okay, we have 1 year 10% note. The adjustment over here is multiplied by 2 over 12. Okay, for the second one, it's look at the date. Based on the date, we're saying since it's 90 days, 20 days have gone by, 20 over 360. For the third one, again, focusing in on the dates, what we're looking at over here is 1 over 12, that would make it 1 month. However, we didn't have it for the full month, so multiply by half. Add up the 3 numbers, and these 3 numbers, when you add them up, that's what's the total interest. We do only one journal entry. We keep a track of who owes us how much money for interest, but we do only one journal entry in our books. And the next video, we're going to take a look at the remaining 3 parts. On maturity date, what happens when a customer makes payment, doesn't make payment, when we have to write off the note, how we are going to deal with that. So that's going to be in the next video.